In the high-stakes game of modern enterprise, the allure of explosive growth and charismatic leadership can often overshadow the bedrock principles of sound business strategy. We've witnessed established giants crumble under the weight of inertia. But what happens when a company builds an empire on ambition alone, seemingly defying gravity, only for the foundations to reveal themselves as a house of cards? This is the WeWork house of cards: valuation versus reality. For a time, WeWork was the darling of the startup world, a symbol of audacious ambition and a seemingly boundless future. It wasn't just an office space provider, it was a movement, a community, a lifestyle. Its valuation soared, reaching stratospheric levels, transforming it into one of the most prominent unicorns of its era. This was a company that seemed to rewrite the rules of business, powered by relentless expansion and an almost intoxicating vision. But beneath the dazzling facade, a critical disconnect was brewing between perceived value and fundamental reality. At its core, WeWork's initial business model was deceptively simple. Lease large office spaces, renovate them into stylish, flexible co-working environments, and then sublease them to individuals and companies, often with added amenities and a focus on community. The community pitch, championed by its charismatic co-founder, Adam Neumann, was powerful. He sold not just desks, but an experience, a lifestyle, a network. This vision, combined with aggressive capital injections from SoftBank and other investors, fueled an unprecedented global expansion. WeWork moved into new cities at a dizzying pace, rapidly acquiring prime real estate and projecting an image of unstoppable momentum. Early strategic advantages included stylish design, flexible terms appealing to startups, and the cultivation of a vibrant, interconnected professional ecosystem that appeared to transcend mere property rental. The strategic flaws, however, were deeply embedded in its financial engineering. WeWork's core business model was simple real estate arbitrage, taking out long-term leases on properties, often for 10 to 15 years, and then offering short-term flexible memberships to clients. This created an inherent mismatch: long-term liabilities against short-term, often precarious revenue streams. As WeWork expanded, so did its commitments, locking itself into billions in lease obligations. Yet, the company aggressively sought a tech valuation, arguing it was more than just a real estate company. It was a technology company, a community platform. This narrative allowed investors to overlook astronomical operating losses and persistent negative cash flow, justifying valuations typically reserved for software giants with high margins and scalable products. Data streams from this period reveal staggering burn rates, with the company spending significantly more than it earned, propped up by continuous massive rounds of private investment. This was not merely growth investment. It was a desperate need for capital to cover operational deficits, fundamentally driven by an unsustainable leasehold model and aggressive expansion. The moment of truth arrived with the filing of its S-1 document for its highly anticipated initial public offering. Public markets demand transparency, and the S-1 laid bare the company's inner workings for all to see. What it exposed was shocking: a staggering $1.9 billion loss in 2018 alone, a complex web of self-dealings where the founder personally profited from transactions with the company, and governance structures that concentrated immense power in his hands. Investors, suddenly armed with verifiable data, saw past the hype. The tech company narrative crumbled under scrutiny, revealing a deeply unprofitable real estate firm with a reckless spending problem. The market recoiled. Valuation estimates plummeted from a peak of $47 billion down to a mere fraction. The strategic withdrawal of the IPO wasn't just a setback. It was a public acknowledgement that the market's perception no longer aligned with the company's carefully constructed reality. The reckoning was swift and brutal. With the IPO withdrawn and confidence shattered, WeWork's valuation plummeted by over 80%. Its visionary founder, Adam Neumann, was forced to step down amidst immense pressure, marking the dramatic end of his era of unchecked power. The company underwent a radical reassessment, shedding non-core assets, laying off thousands of employees, and attempting to return to the fundamental, albeit less glamorous, business of providing flexible office space. The once unstoppable growth machine was brought crashing back to earth, forced to confront the harsh reality that a compelling vision alone cannot sustain a fundamentally flawed business model. The WeWork saga serves as a potent case study on the critical distinction between market hype and fundamental business strategy. It underscores that while charisma and vision can attract capital, sustained value creation relies on robust financial models, ethical governance, and a clear path to profitability. In an era where unicorn status often overshadows profitability, the WeWork experience reminds us that data, cold hard data, remains the ultimate arbiter of value, cutting through the noise of charismatic leadership and exposing the vulnerability of a house of cards built on ambition alone. Join us next time on the Boardroom Gambit as we scrutinize the blockbuster endgame, a missed checkmate, and explore the perils of strategic inflexibility in the face of inevitable disruption. If you found this analysis insightful, be sure to like this video, share it with your colleagues, and subscribe to the Boardroom Gambit for more deep dives into the strategic plays that shape our world.